Most people want to maximize their tax efficiency, and a little-known rule on income generated from U.S. government bonds could result in state tax savings for a lot of people. My name is Nathan Haskins, and I'm one of the owners of a wealth management and financial planning practice called Free State Advisors. It would be a dramatic oversimplification to say that tax law can be complicated. It's important to understand how it works because no one wants to pay more tax than they owe. Tax topics are broad, but today we're going to focus on one opportunity related to dividend income from U.S. government obligations, which is just another word for bonds. Income paid from U.S. government bonds is taxable at the federal level, but it could be exempt from state income tax for a lot of people. The rules are state-specific, and residents of California, Connecticut, and New York are subject to additional requirements to be able to use this potential tax exemption. So how does it work? You might expect to see this information on your 1099 composite form, but that's usually not the case. Custodians often don't include it because it may not be available time, and it's also not the custodian's responsibility to interpret if that information is relevant to each account owner. Instead, when income is from a mutual fund or ETF that holds bonds, the information is published by the fund manager each year. Then, it's up to the account owner and their team of finance professionals to calculate the potential exemption and determine if it applies to their situation. Let's look at a quick example. In this case, fund manager BlackRock established that 33.59% of income generated by their aggregate bond ETF, AGG, was derived from U.S. government obligations. The income generated from the AGG fund is listed on the 1099 composite form, and for sake of example, let's say it was $10,000. The amount of income that could potentially be exempt from state tax would then be 33.59% of $10,000, or $3,359. As an example, in a state that has a 5% income tax rate, this information really could potentially result in approximately $168 tax savings. In accounts that generate substantial income from U.S. government debt, it's possible that account owners could see a really meaningful savings on state income taxes. Now be sure to confirm this information for your situation and work with your accountant to understand if this exemption is relevant for you. For us, it's one more way that we try to give clients information that could be valuable. I hope this tax topic has been helpful for you. If so, feel free to share it and subscribe for future updates. Remember, don't use this information directly as tax advice because every situation can be unique. But if you have any questions or want to discuss it further, don't hesitate to reach out to us. Thank you.